Innovation solves problems. And you heard about a lot of the breakthroughs that are going to solve problems. We saw it last year with COVID. In the last 2 years, COVID, innovation solved problems. We had tests and vaccines that no one dreamed we would have in the short time period that we got them. And it was all because of innovation. Now we have supply chain issues. We have labor shortages. We have the cost of capital going up, and we have automation of all kinds, and we have DeFi. And so we really do believe that the innovation in that we are researching is a wonderful complement to the traditional asset management oriented portfolios, the traditional growth and value portfolios that are benchmark sensitive.
Cathie Wood, the founder and CEO of ARK Investment Management, said that innovation stocks are in deep value territory. Despite the downfall, Cathie believes that higher rates punish growth pockets of the stock market that rely on low rates to borrow for investing in innovation. Innovative stocks' future earnings look less attractive when rates are on the rise. Cathie does not invest in big tech companies like Microsoft, but she bets on companies at the forefront of disruptive technology in a variety of industries. Some of these industries range from DNA to automation, robotics, and artificial intelligence. Her top holdings include Zoom, Tesla, Roku, CRISPR Therapeutics, and UiPath. Some of the companies Cathie invests stocks into are down by 60%, but she's still optimistic about her positions. She believes the future of technology stocks will continue to be innovative. Let's dive into how Cathie justifies her narrative on innovation and inflation unravel.
We know that innovation in the equity markets, the public equity markets, not the private equity markets, has been ravaged in the last year. It's about a year that it has been ravaged. And Raul mentioned that when there is a change in expectations, and last year, as we were getting our vaccinations, the thought that the economy would open up and interest rates would go up, inflation would go up, but would be tamed. During the year, there was a change. The supply chain issues did not go away. And so this fear about what inflation and interest rates are going to do has gripped the market. First, it gripped the innovation space almost exclusively in a puzzling way. Now it seems to be affecting the market a little more broadly. But I will say now that the 2-year Treasury and the market itself has priced in at least 4 interest rate hikes, this possibility is priced in the equity markets too, increasingly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. So I think the fears here are going to shift from rising interest rates and higher inflation, potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem. So innovation stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year. That's as bad as it got during 08-09. Now, in the private markets, of course, we're seeing one example after another where the pricing is up in the last year. We're seeing up 50 to 100%. And I think the private markets do have it they're more correct in terms of what they should be discounting right now because of what you heard today about research, how profound the changes are, how exponential the growth will be, and how the equity market cap is going to explode in these areas. And we really do believe that will be the case. Now, besides interest rates and inflation, there's been a double whammy in the public equity markets. And I think this is what helps explain what's going on. The move to risk off for many traditional asset managers means get back to your benchmarks. And if you look at the broad-based benchmarks, even the broad-based tech benchmarks or tech-oriented benchmarks, you're going to see that they are short innovation, true innovation. They're mostly in that the innovation that they're capturing is mostly in the mega cap tech stocks. They've become a disproportionate weight in many indices, and I would submit in many portfolios in the traditional asset management world. This move to benchmark style investing, we believe, has been turbocharged during the last 20 years by the tech and telecom bust first, and then the 08-09 meltdown. And the risk aversion in the markets is palpable. And so going back to benchmarks or repositioning portfolios so that they are closer to their benchmarks seems to be what has been going on. What happens then? Well, they're selling the real innovation stocks out there, the emerging innovation stocks, and those that are going to create the outcomes that we showed you in our research today. Traditional research is becoming very benchmark sensitive as well. It's not just the portfolio managers, it's their analysts. And they have also become very short-term in their time horizons. There are two other characterizations of traditional research out there that ARC has actually tried to capitalize on in terms of inefficiencies in the marketplace. The coverage in the traditional asset management world of analysts is broken down primarily by sector or industry or sub-industry, very specialized, very narrow, and as I mentioned before, typically very short term. And because of the siloization, their ability to understand the convergences that are taking place between and among the 14 technologies that we touched on today, they're not able to see them as clearly as we are. We are looking for them. And so the way we've set up our research, ARC is benchmark agnostic and long-term in its time horizon. Our investment time horizon is 5 years. And therefore, our analyst responsibilities are set up in a way to encourage the collaboration and explore the convergences between and among these technologies. Their responsibilities are set up by technology, very, very different from the traditional asset management world, because we believe each of these technologies is going to cut across economic sectors. So they are specialists and they are domain experts in these technologies, and they're generalists when it comes to sectors, because these technologies are going to fall in price, and therefore access will open up to many more sectors, in many ways going mass market. So I'd like to talk a little bit besides that about the differentiation. We have, as I mentioned before, Brett Winton, our Director of Research, MIT engineer, educator, an entrepreneur, and a financial analyst for years. We have our analysts, the domain experts. The collaboration that you see is visible, and it was today on the seminar, when you listen to William talk about artificial intelligence, and then you hear our genomics analysts, so Simon and Ali and Pierce as well, Sam and Tasha in the autonomous world, Sam again in the space world. Artificial intelligence is the glue that is pulling these technologies together, giving us a lot to collaborate on as analysts and portfolio managers. Our research is centered on Wright's Law. That's another thing that you're not seeing in the traditional asset management world. The only way to truly size these opportunities is to understand how quickly the costs are going to fall and what will be the price elasticity of demand. So innovation solves problems. And you heard about a lot of the breakthroughs that are going to solve problems. We saw it last year with COVID. In the last 2 years, COVID, innovation solved problems. We had tests and vaccines that no one dreamed we would have in the short time period that we got them. And it was all because of innovation. Now we have supply chain issues. We have labor shortages. We have the cost of capital going up, and we have automation of all kinds, and we have DeFi. And so we really do believe that the innovation that we are researching is a wonderful complement to the traditional asset management oriented portfolios, the traditional growth and value portfolios that are benchmark sensitive. Because if we're right, there is going to be a lot of creative destruction in the traditional world order that is represented by the more traditional benchmarks. And if that is right, then a hedge with innovation strategies is not only appropriate, but we think will be necessary. And I do want to talk a little bit about volatility here. Volatility has become the watchword. And as Brett said in his opening remarks, many people associate volatility with risk. Volatility is more associated with uncertainty. And when time horizons collapse, as they have within the last year, then the volatility does increase. We use volatility to our advantage. We concentrate towards our highest conviction names, and that tends to work out very well as we go through these corrections. I will say, as we go through these corrections, and in terms of the way we are being covered in the market, there are some unfortunate instances where journalists are using endpoint sensitivities, and they're kind of random, the time periods they're using, and really quite unfair. But I guess I'll close by this section by saying, inflation and interest rate risks seem to be priced in when you've had this kind of a correction, and the broader market has joined in as well. We do believe that innovation is on sale, and we do believe that it will be really important for investors to move toward the right side of change, given the amount of disruption that we do expect, and that I hope our research today telegraphed to you. It's also very important to keep that 5-year investment time horizon. The difference between linear growth and exponential growth when you're talking about a 5-year period is enormous. And because Wright's Law gets us to, I think, to the right answer in terms of the exponential growth trajectories, the surprises are going to be enormous. And most important, we like to say, as we're focusing on the 5 years, keep your eye on the prize. We realize it's been a very difficult market. We also do believe, and our conviction this past year actually has increased, that these exponential growth trajectories have been accelerated by COVID, and even more so now by the turmoil we're seeing in the labor markets, logistics, and in the financial market.
We must win this financial war. Subscribe to keep learning the truth.